Pulled pork time, and
Ah,
I'm doing a pulled pork on Regis Healthcare,
what's their code?
REG, Reg.
Reg. Oh, I don't think I own any Reg. I think
Oh,
it's
that's good.
safe.
Yeah. It won't affect our
What?
performance.
Tell me about Reg, Tony.
Yeah, sure. Aged care services provider. So they operate aged care facilities, retirement villages, home care services, day therapy, and day respite programs. Uh, so people would have seen Regis Health logos around. Um, Probably most prominently, the one I can think of was when my parents were in the retirement village. There was a Regis uh, aged care facility as an adjunct. So as you required more care, as you got older, you sort of just migrated from one part of the retirement villages into more of a hospital type setting and received the care from Regis. So that's my brush with them. Um, they were formed back in 1994 by Brian Dorman and Ian Roberts. Ian Roberts was a property developer and Brian Dorman was an accountant. Uh, and Brian Dorman saw an opportunity when he visited the Cramp facility in Footscray in Melbourne while working as an accountant, and being unimpressed, he teamed up with Ian Roberts to invest in elderly care homes. Um, that was back in 1994. And then 3 years later, there were sweeping changes to the government funding model for aged care in 97, and it improved the sector, and enough so that Dorman and Roberts began a series of acquisitions that led a decade later to a merger with the Macquarie Capital-backed Retirement Care Australia. And in 2013, Macquarie Capital sold its stake in the merged entity to the two founders, who then listed in 2014. Regis Healthcare now provides services and facilities to over 7,600 older Australians and operates 68 aged care facilities around the country. I think looking through their story, particularly in the recent years, there's three important factors to talk about that affect aged care operators. The first being there was a Royal Commission 3 or 4 years ago. The second being there is a population demographic which is trending older. And so the boomers are all getting to that age of needing this kind of care, or starting to anyway. And the third important factor in the last few years has been COVID. So to take each of those in their separately, the Royal Commission into Aged Care has led to the release of a new Aged Care Act in December 2023. It's open for consultation, but the Act will become law at some stage this year. This draft, anyway, Regis believes will benefit them and some of the other providers. And I guess the market does too, because Regis share price has been going up quite well over the last sort of 6 to 12 months. The reasons why it will the Aged Care Act will benefit, or the new Aged Care Act will benefit Regis, is that it does include improved funding, and Regis would get most of its funds from the government to fund beds in their facilities and services. So there's improved funding to cover staff wage rises, and that's regulated by an independent body. There is another independent body the same independent body to provide funding recommendations, which is linked to the actual costs of providing care, which hadn't been the case in the past. There is a mandated system of what they call care minutes. So it's like a regulated number of minutes per day that a nurse and other qualified personnel have to be present and servicing an aged care user. So that will hopefully remove some of the players who aren't doing that from the market. That's also being reinforced by star ratings, so that different operators in the sector will get independent star ratings, which will show the good ones from the bad ones. And some of these are already happening because they were implemented after the Royal Commission. Some of them are in the draft legislation. So this legislation and the output from the Royal Commission has kind of lit a fire under Regis Healthcare stock, because it has improved funding to the sector, which the Royal Commission found was basically a broken model, where the government set how much it was willing to pay, but that didn't take into account the cost of actually providing services, which put these types of companies and providers in a bind. The second thing to talk about is the ageing population. And so the average age of someone entering care at these facilities is around 84. And as the boomer population ages, that demographic, or that cohort of demographic around that 84 age, is getting larger and larger. And it's estimated that in the foreseeable future, there needs to be about $60 billion invested in the sector to meet the demand of boomers as they reach that sort of 84 age cohort and need substantive aged care. The last thing to talk about is COVID, which the company is now coming out of. But this company, Regis Healthcare, and aged care in general, really took a pounding during COVID. With, obviously their patients were the most vulnerable to COVID, and so the regulations around them operating were the strictest. But also there were large staff cost increases because people just didn't want to go and work in an aged care facility. Plus, with the extra regulations, it required more staffing to administer vaccines and to do things as remotely as they could, I guess, in the facilities that were operating. So that kind of hit to their costs has just gone away. They've called out that they're basically over the COVID cost bump, which is helping Regis to return to profitability. And I guess that's the effect of COVID is borne out by the fact that Brian Dorman, one of the owners, his company Ashburn, joined up with Washington Sol Pattinson back in November 2020 to bid for the company in the takeover at $1.85. And that was just after COVID. If they had have been successful, they would have reaped the benefits, because the share price has basically doubled that today. So certainly Brian Dorman, the owner, realised the company was at its low point and that things will get better as COVID passed, and that's come to pass as well. I guess the other point to mention in talking about Regis before getting to the numbers is that it's the last listed aged care play on the ASX after Estia Health was taken over in August 23 by Bain Capital. So healthcare and the play on demographics and the population getting older has always been a favourite theme in the stock market. And so these providers have been taken over and been taken out. Fund managers and a large pool of investments love to play in the space because they can see it. They can see a road to profitability as the baby boomers get older. And so all that's left now is Regis Healthcare. And I guess it does raise the question whether they will last or whether someone will come along and try and take them out, just as Washington Sol Patts did try to do a couple of years ago. But that's by the by. We'll see what happens. But if an investor does want to play in the space, its only option is Regis Healthcare. The numbers. So I picked this one to do this week because it has a large ADT of 474,000. So it's not near the top of the buy list, but it's large enough to be of interest to most listeners. Sentiment is very strong with this company, so its share price has recovered dramatically in the last sort of 6 to 12 months. I'm doing my numbers based on a share price of $3.49, which it was on the weekend, but it's already up to $3.70 today. So since the last figures came out, there has been a bump in the share price, which is still going on. I'm using the latest figures, which are in Stock Doctor now, so that's good. $3.49 was less than the consensus target, but I've got a feeling $3.70 is starting to reach up to it. And as I indicated before, the company hasn't been profitable since COVID. So I can't, the IV1 for this company is negative because we don't have a positive earnings per share to use in our calculation. And IV2 is just slightly positive at $1.12, so well below the current share price. So we can't score it for price or value on price. The yield is reasonable at 3.94%, but it's not big enough to score it as a yield stock. And just to make people aware, it goes ex-dividend on the 14th of March, so it's coming up. Stock Doctor Financial Health and Trend. Financial Health is early warning and Trend is steady. So we don't score early warning, but we'll give it a score for steady. The PE on this stock is not applicable, so we score it as a 0 because it hasn't made a profit for a while. The interesting thing, though, is that this company does have good operating cash flow and free cash flow. They just haven't flowed through to the profit line yet. Regis last made a profit back in December 21 in that half. The big thing I think which is exciting in the market again is this idea of the forecast earnings per share is forecast to be profitable. So forecast earnings per share is 11.6 cents per share, and to make a profit in the next financial year accordingly. So again, I think the market is focusing on what the forecast earnings per share are and placing an emphasis on that. Prop cap for this company is 5.39 times. I'll get that right in a minute, which is good. And net equity per share is only 2 cents. So we can't buy it for book or book plus 30 or anywhere near book value. Growth over PE doesn't score because we have a negative PE. What does score for us is owner founders, and those two members, owners I mentioned before, Roberts and his friend, own 55% of the stock. So very strong presence by owner founders, so it scores for that. I wanted to highlight the fact it's not scoring on consistently increasing equity, and the reason I'm highlighting this is because equity is shrinking dramatically, down from $158 million in December 20 when it last made a profit. It's now down to $4.5 million in December 23. So it's shrunk quite a lot, and it's getting close to having no net equity, which underscores the early warning financial health, and it puts pressure on Regis to return to profitability. So a lot of focus on getting that right, I guess.
And why the big drop in net equity? Is it just loans?
Possibly, but I think they've been using that money to sustain themselves while they haven't been making money. So they've been taking retained earnings to pay for losses, would be my guess, during that period. So yeah, that's been going on, something to pay attention to and a potential risk for the company. But all in all, the quality score is 8 out of 14, 57%, and the QAV score is 0.11, which is just on our buy list, but it's a large ADT stock and it comes on the buy list this week for the first time. Positives and negatives. I think the positives are that the government does seem to be treating the aged care sector with the attention and funding it deserves. So they're also freeing up some of the regulations around opening new centres, and that's, I guess, in acknowledgement and anticipation of the boomer cohort getting older and needing a lot more beds. But that helps Regis in terms of their development pathway going forward. The biggest positive has got to be that too, that the boomers are getting older, so there's going to be a lot more demand for these services going forward. The negatives, the low equity worries me a little bit and does put pressure on them to actually get the profitability, not just forecast it. But I'm also going to highlight as what I think is a negative is, even though it's improving, is government regulation and reliance on government funding. And it's being fixed up now, but it was a big issue for this company prior to the Royal Commission into aged care. And I've just found over the years that companies that rely on government funding can go through periods where the government, for whatever reason, generally because of tight fiscal circumstances, lets the funding slide. And it's like a company with one customer. They're beholden to that customer, and it can go through good and bad times with that. And it happens to be a good time at the moment, but it has been a bad time. And when the government doesn't pay, it doesn't pay. There's no one else to pay. So it can be a problem for these kinds of companies. So I'll highlight that as a risk as well.
Mm.
Yeah, so that's Regis.
They have been on our buy list before. I'm just looking back over the
Okay.
historical buy lists. It's been they sort of come on and off by the looks of it. Let's see how far back I can find them.
And don't confuse them
Mm.
with Regis Resources too, people. They're very different things.
What's Regis Resources code?
Oh, I don't know.
These
You'll
guys are
find it.
REG, right? Yeah,
They
okay.
are. Yep.
Yeah, Regis Resources is RRL, Regis
Correct.
Resources Limited. Yeah, no, Regis Resources, Regis Healthcare. Back in April 22, they were on our buy
Mm-hmm.
list. Uh, March 22, actually. Yeah, they come on and they come off. But just looking at, I don't know if we've ever bought them. Let me see if I've ever had them in the. Let's see if they're in my archive here.
They would have been good buying about a year ago too, because the share price has gone up dramatically in the last year or
Dramatically,
so.
man.
Mm.
Yeah, I've got no record of ever owning them, but yeah, looking at their share price in the last year, it's gone from $1.48 March last year to $3.50 today. It's had a
Mm.
corker of a year.
Mm. Which I guess is
So that
because analysts are working out that the government funding will improve, and this company is so reliant on government funding.
I'm wondering about the nature of this star rating system for elderly care centres. Is it based around the average number of rats found in the rooms of the elderly people? Like if it's,
Well, it probably is.
is it,
You get a
is
one
it,
star
in,
for that.
is it inverse? It's the inverse. So
Yeah. Mm.
for every five rats we find, we take away a star.
Yeah, well, I mean, that's we joke about it, but that's been a problem with the aged care sector for a long time is neglect, because the government hasn't been funding it to the level that it probably should. So,
I mean, the stories that came out in the Royal Commission were just
mm,
horrifying, like a physical abuse, sexual abuse, emotional abuse, just horrifying.
mm.
Like, oh,
Yeah, and I I can't recall Regis's name being linked with any of that, so I suspect it wasn't. And I guess where they're coming from is they're a big player in the field that can afford to set good standards in and pay their staff well, and the star rating will hopefully get rid of some of the cowboys, smaller operators who might be more inclined to cut corners.
trying to decide whether or not I should call this episode "Counting the Rats" or something, but
Oh,
might steer clear. It's too dark even for me.
yeah,
All right. Well, thank you for that one, Tony. It's the one that I wish I'd had in our portfolios
yeah.
over the last year. What did you say it's ADT is?
Oh, it's
About
450 from memory.
474,000. Yeah.
Mm,
Too small for you,
474,000.
but big enough
Yeah.
for most people.
Yep.
Market
Absolutely.
cap 1.1 billion. All righty. Have a look at that, folks.